All right. Hi, everyone, and welcome to our next video on this Blockchain Professionals channel. This episode will be in a podcast format rather than all the previous ones, which have been hosted like a webinar. But still, we are happy to be here with you guys. And I'm joined today by Vlad Shurupov, who is CEO of Algotech. And we will be speaking about digital organisms and the evolution of adaptive trading systems. And before we start, just a quick note that you can guys leave your questions in the live chats wherever you are watching this video, and closer to the end of the session I will go through the questions in the chat and read them aloud to Vlad so that we could cover them. And before we start, just a quick thing, a quick fix to check out that the broadcast is working properly across all of the social media, and I see that everything is fine. And hi Vlad, thank you for being with us today.
Alec, Alec, thank you so much for
Yeah,
inviting me over. It's a pleasure to be
yeah,
here to see you again, and I'm delighted to be engaged in a hopefully interesting and engaging conversation.
yes, absolutely. And before we start and before we dive into the technology that you are building and that you brought to this conversation, to this podcast, could you please just briefly tell us about yourself and how did you start Algotech?
Okay, so life has got the sense of humor and irony. When I was a child, right, I had two big dreams, and those dreams were competing with one another, right? The dream number one was after, I was born in USSR, that doesn't exist anymore. But right back then, science had was cherished everywhere. We had scientific educational channels, etc. So by chance, I came across a book called The Young Cybernetician, and that book was dedicated to cybernetics, the term that's not popular anymore, right? But back then, it was a very big term. To cut the long story short, I read a few articles, and one of them was dedicated to Edison's clock, and I was fascinated how Edison carved from a piece of wood a disk that would repeatedly send out SOS code. And I thought, wow, that's an amazing way of essentially carving out a piece of code, right, and automating ideas. And I got very, very intrigued about programming, and I caught the bug. I was 5 years old then, and I kept on dreaming becoming a programmer, but I also wanted to be a fighter pilot. Interestingly enough, the life would show would combine the two things together a little bit, but first and foremost, I became a programmer. I started programming very early, maybe when I was around 11. Some people would say it's not early, but by the age of 15 or 16, I was already a senior software engineer, doing some very exciting stuff, mostly in the area of system programming. But back then, programming didn't pay well, and I also got very fascinated with a game called the financial markets. And I guess my dreams expanded, and I wanted to trade on the financial markets, and the way I envisaged it was being in the open outcry system, right, environment, where I'd be standing close to the trading pitch, shouting out orders, buy, sell, and hopefully uh, turning this activity into a profitable exercise. But I guess life life took me somehow by intention or side effect into investment banking, commercial banking first, and subsequently investment banking. I guess a major school of thought for me was UBS, where I spent 10 years of my life. And then from UBS, I joined a very interesting global team in RBS. And I guess the dreams of building something out of the ordinary and pushing the boundaries in the trading space pushed us, me and my co-founders, to launch Algotech. That happened 13 years ago. And since then, we've been a successful boutique company specializing on large-scale trading systems, be they order management systems, algorithmic trading systems, predictive analytics, and the trading algorithms themselves. Back in my commercial banking days, I was effectively pushed by life because there's so much I had to do, and I didn't have much spare time, and I was trying to come up with a unorthodox way of solving problems, and essentially started building the trading algorithms initially in VBA in Windows 95. Some of us remember what it was. And then effectively started building trading algorithms before the term algo trading came into existence. So I'm showing my age, right? So mostly my background has been in trading, analytics related to essentially technology and investment banking arena. And then we naturally repeated the same, but in a new manifestation. It's like Phoenix resurrecting from its ashes in Algotech. And in some respects,
Oh,
like you ask me, right, what it is that we're doing different than Algotech. Well, when you work for investment banks, you're always constrained. Yeah, there's a particular agenda, there's a business priority, but we kind of wanted to build the system of our dreams. And when we launched Algotech, we were really naive that we would build it in 3.5 years. It took us maybe 5 to 5.5 years, but we got there, and we've got some exciting technology, and we'll touch upon it, right? But that's not, I guess, the topic of our discussion today.
yes, absolutely. That's very impressive about the career journey that you have had and that you just shared. And yeah, with that background in technology, you probably know a lot of not only technological side of things, but also philosophical side of things, considering the time we live in nowadays. And from the notes and from the articles that you sent me before this podcast, I noticed that you use the word organisms a lot, and usually people don't see that as an organism. I mean, when it comes to technological solutions, people usually see that as a tool or something as a machine. But what's the meaning of the organism, digital organism, in your sense?
Thank you for the question. The idea is simple, but I guess I'll step aside for a second and explain why I use the term organism. I think as a society, as a human society, we have a tendency of not respecting Mother Nature enough, and it manifests in different sort of way. Not respecting in terms of global pollution and disregarding the other life systems that we have on this planet, but also in research areas, be it trading, right, which is a could be construed to be a narrow problem domain, but in a broader spectrum, in artificial intelligence, I think we can learn a lot more than we do now from Mother Nature. Right? Hence the term digital organism. I didn't use it before, and when I was asked, like, Vlad, what are you guys hacking in your back room? And I said, well, typically, like we're building a good Skynet, but Skynet historically has got negative connotation, and it's all Terminator, exoskeletons, and robots built of steel. And I felt I need something softer, hence the term digital organism. And I think I'm trying to give a due credit to Mother Nature that essentially in what we do and how we design systems, we borrow a lot. We borrow a lot from the things that surround us, simple things like trees and insect life and colonies of ants and stuff. And I just wanted to emphasize that as we build things and as we evolve what we evolve, we can borrow so much and I guess contribute back to the ecosystem that surrounds us, the nature, the living thing. Also, the organism, the term implies that we are stepping away, effectively philosophically stepping away from relatively rigid, prescribed ways of dealing with the software. We're opening up the software and give it an opportunity to evolve by itself and exhibit a higher level of autonomy.
All right. And when you say that trading systems should be like digital organisms, and on the other hand, you mentioned that traditional systems are like static machines, what actually happens to them when the market becomes volatile to those static machines? And do they stop working? Don't they stop working? Do they have mistakes? And what's the main difference in the consequences of digital organisms versus the static machines and tools?
It might be a grossly oversimplified example, and I'm just literally, when you ask the question, what I had in mind is, like toys, kids' toys, like jumping chicken and stuff that you wind up and it's making this, like it's a bit clunky and it's making that noise and it moves around to the amusement of kids. That's sometimes how I see like those static algorithms. The idea is like it kind of exhibits the behavior, the desired behavior of a toy, and it's got obviously a very high entertainment factor. But when you project this behavior to very dynamic financial markets, what we often see is that someone comes up with a bright idea, and some of those bright ideas can essentially be implemented in a relatively stationary algorithm. Right? Classical example is a trend following algorithm based upon Donchian breakouts. So two Donchian channels combined, right, can lead to very profitable strategy in the medium to long term. And that approach to building trading algorithms has got lots of merit. It's robust. It passed the test of time. However, what the same trend followers, read CTAs, have observed with the passage of time, especially of the last 20 years, is that the markets have become very erratic. And some people, I really like the comparison. It's like a slippery eel. Just when you think you're about to catch it, it slips away from you. Meaning that when we deal with the financial markets, it's a never-changing machinery. You might be capturing certain phenomena, and you might be capturing certain inefficiency of the financial markets. And sadly, that information that you've caught, that alpha that you've caught, right, slowly slips away. And I guess the drive for higher degree of autonomy and essentially pulling in neural networks. And 20 to 25 years ago, it was just a revolutionary thing to do. I remember talking to one of the desk heads at the time, and when I was starting explaining the idea behind employing neural networks in the front desk, he was just confused. He was just like, the first question was like, how do you know how it's making decisions? I said, well, I do and I don't. But I guess to cut the long story short, what we want to see is those algorithms shaping and reshaping themselves as the market conditions change, especially when they exhibit the higher level of volatility and erraticness. And it boils down to survivability of those systems. What we want to spare ourselves from is constantly pulling out the ideas, or kind of regrouping our ideas, or revisiting our ideas and recalibrating our solutions. We kind of want to let it go. And it's kind of inspiring, and I guess it serves it really well to lazy people just like myself. I'm tempted to let things go and delegate more and more to the machines, but obviously the drawback of the approach is how do you deal with the risks, how do you deal with the uncertainty. But the trend is definitely there.
All right. And a quick question here in the chat. Someone asks, so how a trading algorithm look like? And yeah, before we dive in, just a quick, just a quick question before we speak about the trading algorithms. Could you just, in a couple of words, say us what does Algotech as a digital organism, what kind of problem does it solve nowadays?
Okay, so the problems are multifaceted. And obviously, when you start and think about, ideally, my dream was, well, why can't we, back, say, 22 years ago, 25 years ago, it was very hard because we were so constrained with computational resources. Those deep neural networks, though they existed, right, but the term was not common because we were excessively, prohibitively expensive to use. Right? So back then, you had to use all sorts of tricks to squash the neural networks. Right? So I guess the initial drive, the initial dream was, why can't we let it go and essentially have AI algorithms, trading algorithms, whereby I press the button, right, and let the AI, good Skynet or digital organism, to take over trading algorithms, select the best ones, and let them trade on the financial market. That was the dream, right? But that dream was not kind of disappointingly to me, I guess, took a lot longer than I originally envisaged, right? But that's angle number one. But the most practical angle, testing and refining what we've got now, because whenever you start, be it Algotech or an existing trading desk, the problem you're facing, especially in T1 investment banking areas, that you've got the well-established business, you've got clientele, you've got different business lines, and those business lines are sell trading, so essentially selling the direct market access, smart DMA, smart direct market access, so DSA, direct strategy access to the clients, maintaining the business, managing the inventory, and more importantly, managing the risk. At the same time, there are facilitation desks that facilitate the client trades, right, and essentially help block trading and high liquidity trading to trade on the market and in a hybrid sort of way, on and off the market. And the third activity, which has been frowned upon for quite some time, is proprietary trading. So essentially trading for the bank to trade using its own book. The current tendency is to call those departments quantity trading departments, hedging departments, because their function is still about taking risk, but the way it's structured now is the banks prefer to hedge their risk rather than being engaged in a straight proprietary trading activity, which kind of created a new market for companies like Jane Street, Citadel, etc.
All right.
I'll get back.
And
So coming back, so sorry for the long-winded answer, right? But where did it position to Algotech? Initially, rather than building smart, completely AI-controlled algorithms to trade on financial markets, we actually involved the same digital organism approach, right, into synthesizing the markets used for large-scale testing. So creating essentially an artificial market ecosystem to train the algorithms, to stress test the algorithms, to protect important algorithms against the predatory behavior of the market makers and other HFT operators, right? But slowly and surely we evolve this technology into predictive analytics and algos essentially that are capable of trading in an independent sort of way, as opposed to sell side agency trading.
mhm. And let's come back to the question that was asked a couple of minutes ago, which says
Mhm,
how a trading algorithm look like. And there is
mhm.
another comment which says, I mean, if it's not written in code.
And if it's not written in code. Okay, so I'll start with an algorithm written in code, right? So let me give two definitions. One is entertaining, the other one is boring, but I think both of them are important. So I'll start with the entertaining one. A trading algorithm is not dissimilar to a computer game, i.e., there's something going on, right? And then there's an interaction involved. So I guess the landscape instead of your monitor, right, with sprites and tiles or three-dimensional polygons, right, you essentially have you've got a myriad of events that you're bombarded with, and that's essentially reaches solely or partially the sensory input of the algorithm, right? Quote, in practical sense, what are they? Well, there will be your quote updates, meaning whenever a price changes, whenever the boundaries, the top of the book changes, or whenever there's some indicative price changes, a quote update is delivered to a trading algorithm, being a state, so basically being a game, right? That may or may not respond to that change, right? So the other changes are the order book update, the market status update, the state of the market might change, so the market might be on hold, or the market might hit the closing session if it's a traditional market, or the market might exhibit high level of volatility and the strategy may or may not react to that changing condition as well. Okay, so more boring definition of a trading algo, it's just a state machine. It's a piece of code, right, that runs and interacts with the outside world. And to any action or inbound event, right, it may or may not respond in its own event. What are those events? Well, for primitive trading algorithms, that can be expressed in very finite number of actions, and those actions are a new order single to place an order on the market, and that the orders of different type. An amendment is essentially it's a modification of single or multiple outstanding orders that you have on the market. And the third one, very important one, is a cancellation. So you may be on the market, you may or may not be fully executed on the market, meaning your order is fully or partially filled, and you may make a decision to pull that order out of the market for one reason or another. The important reason is risk. Something has changed in the market, so the surrounding conditions have changed, and you, as an algorithm, have changed your mind about being on that market at a particular price.
All right. And there comes another one, which says, I heard many success stories of using AI in trading. Does it mean that no more opportunities left over to create own profitable trading system?
No, I don't think they are mutually exclusive. Right? I like comparing the markets, and this might be an unorthodox reply, but I like comparing the markets to the world ocean. And if I were to ask you the question, what's the optimal form of surviving in the world ocean? Is that krill? You know, like it's such a widespread life form that feeds whales. Is that a whale? Is that a squid? Is that an octopus? Is that a killer whale? Is that a shark? Or as the case may be, barramundi, right? So They're different life forms, but yet all of those life forms find their way of surviving. And needless to say, as like if you come back to my example, right, some of those life forms consume other life forms, yet all of them persist, persevere, and they somehow survive in the wide ecosystem. And I don't think that the trading algorithms are dissimilar. What it means is that you can actually capture particular inefficiency and have a very stationary rule, and you could milk that inefficiency as long as it persists. And sometimes those inefficiencies persist for years. At the same time, you might be dealing in a highly competitive ecosystem where you're up against other trading algorithms, and you find a way to outsmart them. And I guess again, coming back to my example, think about a killer whale. Killer whale exhibits an unnaturally high level of intelligence compared to other species in the world ocean, right? However, if you look at the sheer number of killer whales, they're in minority. So essentially, by building more sophisticated trading algorithms, you spend a lot more resources, and the most expensive resource is human resource, R&D, right? Which may or may not lead you to success. And then the next resource you'd be paying for is computational resource, meaning that your probability of survival is significantly smaller. But if you break into the top league, you are in a killer whale league, right? You're successful. However, right, as I repeated, a minority game. So purely statistically, you stand a better chance all in all, right, by building a simple, robust algorithm that doesn't involve AI as a human being.
All right. Yeah. And speaking about all that trading systems in the traditional finance, let's make some kind of bridge to the blockchain ecosystems. And in the crypto world, we have something like decentralized autonomous organizations and smart contracts that run automatically. And is your digital organism similar to something like autonomous agent in Web3?
Interestingly enough, so I only started burning that disconnect between Algotech and the DeFi when we attended Consensus. Traditionally, Algotech has been involved in crypto markets, but in an interesting sort of way, right? We are a supplier of a high frequency matching engine, and our target market is tier one, right? Tier one, so top 10, top 20 cryptocurrency exchanges. But as I as I started my paying more attention to DeFi, it became transparent that evolutionary systems landed nicely into smart contracts. And the model of having we used that example in our early discussion with the Stranger Things in Hive Mind, that ecosystem lands nicely into smart contracts and DeFi environment. I have a feeling, right, and because I'm new to this system, that this ecosystem, that the future of finance is DeFi. However, we can't just transition. We can't. And as you can see, the world economy is still in traditional finance, right? But traditional finances is breaking into this world through TradeFi. So you can see a growth in liquidity in cryptocurrencies and digital assets. But I think the next logical transition is for networks like Ethereum to have contracts, that smart contracts that interact with one another and essentially leverage the evolutionary aspects of digital organisms. So self-organizing AI systems that exhibit very high degree of autonomy.
Okay, and yeah, that was about the so-called DAOs. And if we speak about crypto markets, which are open 24/7, and crypto markets, as we know, are very aggressive and volatile as well. And does this ecosystem type of model work for even better for crypto than for traditional banks then?
In my personal opinion, it does. And the reason being is that the crypto markets are relatively young, and the volatility aspect of this market and the instability means more alpha. Interestingly enough, obviously, when their markets are more predictable, and the markets are more predictable when they trend, but the markets, in my experience, trend anywhere between 11 to 17% of time. In most cases, it's noise, it's drift, it's range-bound movement, or some kind of complicated, edgy regression channels, meaning that volatility, if there is a structure in that volatility, and in most of that volatility, there is structure because in most cases, I still find that volatility is an imprint of human judgment or misjudgment, is what AI or statistical trading algorithms thrive on, which means that, again, in my opinion, that cryptocurrency markets in general are more attractive than well-established, read more efficient financial markets. And it does present a window of opportunity now. How long is this window going to persist for remains unknown, but it's definitely very attractive now.
Yeah, hopefully we will see more and more in this field as well. And one more question in the chat, which says, can you explain how adaptive or AI version of TWAP algo or similar work?
Okay, so adaptivity. You mentioned TWAP, and I use TWAP as a hook as an example. So what is TWAP? TWAP, you can actually think of TWAP as a VWAP algo, right, with a very simple profile, i.e., you're essentially following the linear function, right? So you put the linear accumulation of an asset that you're buying or selling, disposing of, right, across time. Okay, so where would AI adaptivity come into play? Well, it wouldn't be TWAP anymore, right? Let's call it adaptive TWAP. Imagine yourself that you've got a straight line that will represent your cumulative volume. So as you progress in time, and you've got like your x-axis is your time, right? So as you progress in your execution, you accumulate volume. And in normal circumstances for TWAP algo, you'll do it in a linear sort of way. But imagine for a second that that line is no longer a straight line. It's a curve. It's a rubber band. And essentially, imagine you've got a single or multiple predictive analytics that are AI driven. And those predictive analytics would be essentially giving you with different level of confidence buy and sell signals. You're buying and you're selling, so you're trading in a unidirectional fashion, right? If I'm getting a sell signal and I'm buying, what does it mean to me? Well, what it means to me is that essentially the asset that I'm trying to purchase is going to depreciate in price, but I've got a schedule to follow. And then the mathematics come into play is that I'll be pulling the proverbial rubber band that represents my volume profile, right, to essentially pull me away from trading activity now. Why? Because I expect the price to become more attractive in the next time being, right? So in my short-term term horizon, I'll be trying to stay away from trading, right? To essentially wait for the price to be more attractive and then trade more. So think about it. I pull this rubber band here, right? But I'll be pulling into the other direction when the price is becoming more attractive. Well, when is the price is more attractive for buying? The price is more attractive for buying when I get a buy signal with a high degree of confidence. So now I've just portrayed the example by essentially pulling this proverbial rubber band up and down. You will achieve better execution metrics, better KPIs with regards to your TWAP metric. So that's essentially how it's done in real life and practice now.
Okay. And yeah, if that answers your question, or just let us know if you need more details. I was actually curious about the thing that you thought that everything is autonomous, and the trading firms are also autonomous. And do you think we will see something like companies which are run entirely by code, with no human traders at all? And nowadays, what's the role of a human in this type of relationship with trading?
When I brought up this topic 15 years ago, I wasn't frowned upon, but people were scratching their head thinking, Vlad, we're miles and miles away from it. I'm personally surprised by the rate of growth, and I said I'm no longer portrayed as the future. I think it's almost happened already. And you might ask me, well, like, what do I mean? I think there are shadows. So in well-established companies, and dear speculate the likes of Citadel. I'm not saying I'm not aware of Citadel's research in the space, right? But I'm speculating that companies of Citadel's or Jane Street caliber would be at least building the prototypes of autonomous trading desks. I would go as far as saying that I would see those kind of entities to be almost autonomously run. The only holder of the keys or last remaining breathing human being remaining in those kind of entities is going to be a person responsible for risk. So risk is the utmost priority for those kind of organizations because it's still open-ended. And bear in mind, for traditional finance, you've got the very stringent, strict regulatory environment, and it'd be almost impossible to explain to the likes of Securities and Exchange Commission, right, or ASIC in Australia, right? Hey, my company is run by AI. So I guess it's just like AI controlling an unmanned aircraft. Yes, you can employ all sorts of sophisticated algorithms, right? But you will have to have at least a department, or you would have to have a compliance department and risk department supervising risk, despite the fact that the majority of activity is going to be carried out by the machines.
All right. And one more question, which says, do you work in HFT space?
I don't work directly in the HFT space. Our angle is traditional trading. We are servicing like tier one banks, and tier one banks, despite the fact that they do provide naked access to HFT firms, right? And they do provide HFT capabilities to these trading firms. The majority of our work is related to large-scale algorithmic trading,
All
and that
right.
is sell
And
side. Mhm.
mhm. And yeah, I was also curious about applying this kind of solutions to the blockchain sphere. Could you please tell us what's happening right now in terms of getting into the field of the blockchain and Web3? What stops you from working more on the blockchain side of things other than traditional finance? And what's the main barriers right now that, other than that you mentioned that blockchain is pretty young? And is there anything else?
I guess we all have different takes, and if we had infinite resources or our extraordinary amount of resources, I would probably set aside like a reasonably sized team and do just pure R&D. But unfortunately, the commercial reality for Algotech dictates a particular way of doing things. So one of the compromises we had to make as a company early on, we could not just build the system of our dreams in one go in a big bang sort of way. We had to sell it in piecemeals to various clients who were funding those different piecemeal projects to essentially assemble a powerful system together. And our approach to crypto markets is not dissimilar. I guess our cunning plan is to essentially, because we are established in TradeFi, is follow the TradeFi route because we're attracted to liquidity, and liquidity means financial resources for us. So the idea is very, very simple. We borrow all the good things that we've learned on the traditional financial markets, and we bring them into the context of TradeFi first, because it gives us liquidity, and liquidity means energy, and it means essentially money for Algotech. However, surely but firmly, we want to integrate deeper into DeFi. The main obstacle for us to enter DeFi momentarily is the relative lack of liquidity, or relatively small liquidity in the trading places compared to the TradeFi markets. However, right, I believe the situation will change. Naturally, with an increase of TradeFi market and just general market penetration of digital assets across the globe, we'll see a lot more in DeFi. That's one angle. So the one angle is purely commercial, but I guess the visionary angle or rebellious angle in me uh, wants me to essentially push Algotech deeper into DeFi. It's just an attractive ecosystem that presents a solid alternative, or much better alternative in my personal view, than the traditional finance world that we live in now. And I
All
guess
right.
for all the same reasons that Satoshi Nakamoto proclaimed in his initial paper. So I side with them.
Yeah, yeah, that's much more complex
But then
than
again, to
that.
keep to kind of summarize my answer, right, we rightly or wrongly we follow liquidity, and liquidity is still in classical like trading. Those central limit order books, right, and in the top crypto exchanges are the ones that generating most of the volume. But I slowly but surely I expect that picture to change with the more and more liquidity being poured into the DeFi markets.
All right. And yeah, that turned out to be much more complex than I expected. And when we speak about AI, how do you make sure that AI doesn't go crazy and suddenly you lose all the money in a few seconds? And how do you stop AI from doing this kind of crazy steps and crazy things?
Alec, the simple thing is like with the saying in Russian, measure 7 times and cut once. But I guess the practical implementation of it is we test and test and test and test and test before we scale things up. And I guess three things come to the rescue. The thing number one is we can always replay things from the traditional markets and basically run our trading ideas, new algorithms against replay data. More often than not, this old technique, and I call it a legacy technique, is now replaced with our new initiative that has been live for the last few years, artificial markets. So basically, we have a machinery using the same digital organisms to evolve, to build an ecosystem of bots that we call them agents. And it might be confusing term because agents are used in the context of multi-agent systems, agents are used in the context of LLM agents, and we also use agents in the context of the agents that synthesize the markets, that exhibit kind of intelligent behavior and create a complex market ecosystem. And that's what we've been doing for the last few years. And as we run and test our trading algorithms before we push them into the production environment, that gives us a high degree of confidence. That's number one. Number two is if you look at the algorithm development, there's always an objective function. And the key objective functions for any trading algorithm, dare I say, is to adherence to KPIs, right, for the sell side algorithms, and for the proprietary trading algorithms, so market algorithms, is the quality of returns. And people look at different things. Like for some people, high quality of returns is high Sharpe ratio. For some people, might frown upon Sharpe ratios or Satina ratio, or Kalma ratio. Irrespective of what ratio is applied, the key objective of the algorithm is to improve or deliver high quality of returns. However, think about a sophisticated AI strategy. It might actually do some unexpectedly unpleasant things to improve the quality of returns, i.e., spoofing the market. Just like a human trader has the tendency, right, or temptation every so often, right, it happens in life to spoof the market to help himself, a completely legal activity, right? An AI algorithm falling into the same trap would exhibit the same features, right, to tendencies. So you might ask me, how do you constrain it? Well, when you've got a stationary algorithms, and we were discussing the difference between static algorithm and a piece of AI. Static algorithms is easy to control because you know what it's doing. With AI, those things can become very, very sophisticated. So my personal take on it is to essentially set up AI against AI. And that I like using an analogy of a human brain. So you've got two hemispheres of your brain that carry out kind of distinctly different functions. You've got a creative right hemisphere of your brain that creates things. And I like comparing it to trading algos. And kind of the objective functions of those things, right, is to again try to improve the quality of returns if it's applied to financial markets. The left hemisphere of the brain is about constraining, right? Constraining you when you make decisions so that you don't stick out in your social environment and don't come across as a crazy scientist or not, right? And the same applies to the digital organism, to artificial ecosystem. So half of that ecosystem, roughly, right, is a creative one, and half of that ecosystems are essentially same kind of, well, different algorithms that use the same kind of machinery whose objective function is to constrain the creative part. For example, right, any kind of positive feedback loop or temptation of the creative algorithms to spoof the market is immediately identified by the sentinels, the agents, sentinels, and they take preventative measures to stop the algorithm, to pause or to stop or eradicate the algorithm that exhibits abnormal behavior. Those objective functions for the sentinels are essentially what you'll read in a classical compliance book. Okay, don't sweep the order book, right? Do not create fictitious transactions, right, to help your primary transaction, etc., etc., etc. So the argument in favor of AI taking care of this kind of compliance is basically, if you look at the human being, right? Human beings are incapable of stopping very sophisticated algorithms. So what do? You trade another type of algorithms to counter the side effects that might be exhibited in increase the intelligence of algorithms that directly trade on the market. So essentially, you've got a creative hemisphere, the right hemisphere of the brain, constrained by the left hemisphere of the brain, represented by those sentinels. And that's kind of a fresh take on how AI would reach that homeostasis and behavior, like trading behaviors on the marketplace.
All right. And I see that we have a couple of questions in the chat and just bringing them up. And it says, can your algorithms make difference between fundamental price movement versus movement driven by market manipulation?
At times it's difficult. Without mentioning names, I actually wanted to bring an example from real life. Ages ago, right, I was guilty of trading using a highly sophisticated AI-driven system. And I remember that system essentially screaming to buy a particular company. Screaming to buy a particular company, and it's hard to be a statistical trader, and I'll explain why. Because system is driven by market behaviors, and it was trained on market activity. And when I, being a trader, right, and also the person who kind of understands the market, I looked at that particular company, and I had an inner conflict. I've got an AI screaming, well, I want to establish the position, and it was a kind of a medium frequency trading, so I had more than enough time to interfere with it. I looked at the stock. The stock was terrible, just terrible history, terrible management, and it showed no signs of kind of activity. And I decided to side with AI, just because I thought, well, like, who am I to superimpose my ideas? At the end of the day, I'm a statistical trader. And I kind of gave a green light because there was an approval process, approved the positions taken by the algo. And my boss looked at those positions at the time. He just said, this is just insane. Do you know what you're doing? I said, well, am I within the risk boundaries? He said, yes, you are within the risk boundaries, but who on earth would buy the stock? Nevertheless, right, the stock, I enjoyed the drawdown, like all of three distinctly different AI strategies. We're sitting on a drawdown a day after, but 2 days after, the stock skyrocketed. And I tried to come to senses, right, like as to why it happened. Well, as it turned out, management announcement was not as bad. It was relatively bad, or maybe neutral to negative, right? But it was so much better than the historical announcements. And upon further examination, I think the algos at the time sniffed out insider trading activity. Obviously, proving our point was easy because we had predefined formulae, we had the machines, right? But they sniffed out something that was not kind of obvious to a human, like to a naked eye. And I think that's just a striking example. But in answer to equations, it's hard. It's very, very hard sometimes to see whether you're looking at a fundamental shift, right? Or a manipulation, because for sentinels, however, it's easier. Why? Because that information is not coming from the market. You're essentially capturing the intentions of the algos. You know, your algos are doing stuff, and it's actually very easy to classify that action. So classical example: if your algo is buying, and all of a sudden you see kind of a small orders coming from that algo that are crossing the spread in the opposite direction, i.e. they're selling before they buy, that's clear market manipulations. What are they doing? They're kind of dropping or affecting the short-term sentiment in the stock or a digital asset to establish a better price for the algorithm. So read, cross the spread in small volumes, the price kind of subsides, and then you cross in the opposite direction at volume and catch the public by surprise. That's a classical example of a market manipulation, and it can be easily captured by the algorithms because you have, in a sense, inside information about what your algos are going to do as opposed to the other market. If the counterexample would be, I'm using the same algorithm as a surveillance system, and I think detecting a market manipulation as opposed to genuine activity there is a problem that's an order of magnitude harder.
All right. And I see the questions are coming. And one more here, which says, how fast is AI driven reaction time compared to traditional algorithms based on state machines? What AI models you use when you need microsecond level reaction time?
I really, really like this question, and I think it's a timely question because we're living in the world of overhyped. Like what we, if you ask any person now, right, what is AI? They'll go LLM, LLM, LLM. But think about it for a second. You mentioned microsecond range, and this is essentially the area we live in. We count things in nanoseconds, so we are not HFT. But when I say we are not HFT, we're still in microsecond range. So read it, maybe slow HFTs or maybe HFT as opposed to ultra high frequency HFT. So we're not in tens of nanoseconds. But when you've got a microsecond or two, you can actually make very sophisticated decisions. But the question is, how is it done? The way it's done now, right, or at least in our systems, poking into a well-trained, relatively small neural network, right, and getting an output, right, takes tens of nanoseconds. Or people would argue, well, if it's a PGA or it's an assembly or it's hot code and it gets it's an L1, L2 cache, right? It's even faster. But the fact of the matter is, right, we draw a clear distinction line between training an algorithm, right, and essentially building a neural network and compacting as much as we can that neural network so that its response time is minimal, right? And essentially using that neural network. How is it done in any practical sort of way? You've got an algorithms making decision, and they've got their brains. Those brains are trained in a sophisticated kind of training environment, right? So supervised, open-ended, and highly autonomous supervised training environment, right? But once that brain with a set of skills is trained, it's very relatively easy to poke the kind of send signals into it and get a very meaningful, very fast answer out of it. What we do in parallel, however, is that we've got a sophisticated digital organism-like system that trains those trading algorithms. I hope it answers the question. So the clear distinction line, fast neural networks, shallow, I like using the term shallow AI as opposed to deep AI, as opposed to deep AI trading those shallow brains, right, that make fast decisions in microseconds, in microsecond time horizon.
All right. Yeah, I really hope that answers your question. If not, just give us more details. And in the meantime, we are moving on. Another question: is this real edge shifting from price prediction to intent prediction, and how do you model that?
Oh, I like that. Uh, I'm going to give an answer. Okay, so I'm going to start with the thing. I've never been successful at price prediction. So I've got a confession to make. I'm hopeless at price prediction. So I cheated and I pretty much gave up on it. And you might ask me, well, like what does it leave me in? Well, it does leave me with a lot of things. So what is a price prediction? Well, that's predicting the magnitude of that short-lived vector of price, which gives me the direction of magnitude. I kind of cheated a bit, and I'm resorting myself to unit vectors. I'm pretty much giving up on magnitude. What does it mean? If I give up on magnitude and price prediction, that shrinks my dimensionality, the dimensionality of my problem significantly. But what would I predict? Well, I like predicting inflection points in delta and inflection points in gamma. What does it mean? Well, what it means is that if you've got a predominant market trend, I'm trying to assess the probability of it breaking or grinding to a halt. And I'm trying to essentially apply that information on how I would react in changing my behavior, like in the algorithm. I've never been successful in predicting the prices. I have looked at different models, and obviously for price prediction, my take on it, you need deep AI, you need deep learning, and that's the very thing I wanted to avoid in my practice for the reason that gentleman asked before, right? Well, how do you stay in the microsecond range? You fight vigorously for dimensionality reduction. And in my case, philosophically, very early on in the game, I gave up on price predictions altogether, right? Now, the important second half of the equation is very, very important. Intent prediction. Well, intent prediction lands nicely into inflection point prediction. Why? That's a change in the sentiment. That's a change in the behavior of the market participants. Sorry to give you a complex reference, right? But the closest thing I can think of in predicting the intent and dealing with intent, I guess my philosophy lends into Soros's book called The Theory of Reflexivity. It's a reflexivity market phenomenon. That's an overshooting reaction between participating function and pricing function of market participants. That's a bit of theory.
All right.
But I
And
believe that not being fixated with the price predictions gives you an edge, and that edge is computational,
mhm.
meaning that you can make meaningful, very important decision in a fraction of time without resorting to communicating and seeking advice for the high degree of intelligence.
Interesting one. And moving on, one more question here. Have you considered or experimented with adding human readable action explanation as one of outputs of the AI driven algorithm? So, not just a decision, but also explanation of motivation.
Well, at the very least, it's a dream, right? It's something that I'd love to see from each and every algo, because you just try to interpret to as to why it's making decision. But I've got some good news. There's only so many ways to skin a cat when you trade. And then what does it mean? Well, actually, any complex market, at least the market taking activity, can be boiled down to very simple tactics. Right? Let me give you a few examples. Right? It's like, how can you trade the market? Well, one of the best ways of trading the market, because it's so robust, is trend following. What you do is you essentially try to capture fat tails and the distribution of returns. We all know that the distribution of returns on financial markets, at least most of us, they are not look normal. They're tailed, like they've got fat tails. And with a lot of markets, it's actually leptokurtic, meaning that the kurtosis is very high. The kurtosis is very high quite often because of the predatory behavior on the top of the order book of the 850 operators. The fat tails are actually caused by biases, constant biases that we see, the very biases described in the book I mentioned earlier, right? Soros's theory of reflexivity. But boy, again, coming back to describing of trading activities, trend following. Number one, benefits of trend following: super resilient. The disadvantage of trend following: every so often the markets enter, more often than not, they enter in erratic, volatile mode where there's no clear trend in place. And the bad news are, right, only, as I said, 11 to 17% of the time you'll see trends forming, right? But more, and I guess the recent markets would not be a good example, but historically there's a lot of noise going on. The very noise loved by mean reversion traders, and the very noise that essentially causes erraticness for CTAs. If you look at the quality of returns of CTAs, if a CTA is trading with 1.5 Sharpe ratio, they're doing remarkably well. They're trading with 1.1 Sharpe ratio, they would say they're doing remarkably well. You'd find a big proportion of CTAs as good CTAs are somewhere in 0.7 to 0.9 Sharpe ratio category, meaning a lot of noise, lots of drawdowns. It's very, very hard to run those kind of algos. Let me give you a counterexample: mean reversion. Mean reversion is when you're effectively collecting pennies in front of a bulldozer. And if you're very fast and I guess experienced in it, right, you can successfully collect those pennies. And if you look at human scalper, or if you look at the classical mean reversion strategy, whether it's stationary or it's got some predictive analytics, you're essentially trading up and downs in the market, and you may or may not be disregarding the trends. Smart algos do pay attention to the trends, so that there's a tendency, so that you skew your risk accordingly. What are the other types? You've got breakouts that kind of lend in between, well, lend more to themselves more in the trend following camp. There are fake outs on the market. So what is a fake out? In the trading jargon, a fake out is something that initially looks like a breakout, but it doesn't eventuate in any kind of breakout where the price eventually snaps to the mean reversion mode, right? What else do you have? Well, if you take Greeks into account, options, you've got dispersion trading. Coming back to delta, there's also volatility expansion, contraction trading. But coming back to the original questions, you can actually use this classification technique to see where that algo is operating, number one. So you can actually explain, okay, right? Clearly, it's seeing a value in this regression channel and it's trading on the upside. So it's basically calibrated a smart detrending function that it's driven upon. Sometimes it's hard to determine whether the algo is trying to establish a well-timed position into a trend or in mean reversion technique. The way to kind of constrain it and get more human readable output, you essentially slice the thing into sub strategies, tactics. So you've got a trend following tactic, you've got a mean reversion tactic, and they by themselves are easy to explain when we make a decision, although it's a black box. So you've got a black box, but you can actually make some meaning out of the signal. And I guess the skill is in combining those small boxes into a more elastic and intelligent network. Right? It's not dissimilar to human being. Like we are who we are, and we are the pinnacle of intelligence on this planet, right? But if you look at ourselves, we're highly agentic systems. Take an immune system, for example. Irrespective of what we think and what we do, right? The immune system does its own job, and that's how we that's what we're trying to mimic in the trading algorithms. Dissect it to smaller problem domains, immune system countering the viruses and nasty bacteria as opposed to good bacteria, right? And then higher level of intelligence where we walk and talk and we make major discoveries and we do good things and sometimes bad things. And I guess that's kind of analogy I would use.
All right. And a couple of more questions are coming here. Did you have to adapt your trading algos for crypto markets, high participation of retail traders, extremely small tick sizes, etc.?
The answer is twofold: yes and no. So no is when it comes to the fundamental logic in the algorithms. Why? Because I firmly believe that the good algorithms should be asset invariant, i.e., if if both markets are traded by human beings, right, irrespective of the structural differences, right, you should be able to trade them in the same sort of way. So in that respect, no. But yes, in the sense that yes, you've got much higher level of granularity, right, with this market, and you do need to take it into account in algos. And it's mostly on the configuration level rather than philosophical level, number one. Number two, the thing that hurts, and you didn't mention it, but it bites really, really badly, so is a relatively higher level of commission. So the things that I could scalp in the traditional futures markets or prime FX market, for example, even stocks, right, is not necessarily available in the cryptos I want to trade because of a higher commission rate. As a result, I need to crank down the frequency of trading with the algos, unless I can go for a very high volume. To give you an example, right, if you could pump $35 million a month with Binance, they will give us a hefty discount that would allow us to scalp in the high frequency range. So there's a bit of a chicken and egg. Obviously, other exchanges are more competitive and maybe more competitive in that space. So on that level, we have to adapt. Another admissions I wanted to make: Algotech almost got caught with fractional quantities. It so happened that we did nothing in CFDs, we did nothing in fractional stocks, and we did nothing in fractional futures trading. So it was a little bit of a pain for us to adapt to fractional trading, but it was mostly around infrastructure, not the algos. The algos are kind of agnostic to whether the quantity is fractional or not. In fact, all of our algos think in terms of double prices and double quantities because they are highly quantitative. However, we had a bit of a pain in filing the rough edges by moving into the fractional quantities. The algos themselves were fine, right? But the infrastructure had to be adjusted a bit.
And I think we have time for covering one more question here, which says, how do you simulate a market that includes other competing algos without knowing what those algos actually are?
How do you simulate a market that includes other competing algos without knowing what those algos are? Okay. Practically, the way we do it now is twofold. So there are two categories here. Imagine super fast algos, so the algos that can cheat, and the algos. Okay, so the way to describe it, the algos that can cheat, and I don't want to badmouth the HFT traders, but imagine that you are a trading house, like you're an investment bank but you are not involved in HFT, meaning that your time to market, whether you like it or not, is by definition uh, higher, right, than the high frequency space that HFT operators to enjoy. So this is that plane. So for us to mimic the activity on that plane, we engage things that we call exchange-based agents. Think about a generic exchange simulator that we fine-tune to the shape of Tokyo Stock Exchange, Nasdaq Exchange, ASX traditional exchange in Australia, or Binance. Right? So on that level, what we do, well, the agents, you don't know what's on their mind, right? They're unpredictable in their complex interactions. They create more or less realistic market. That's one thing. But now imagine you've got agents, and it basically mimics the market in its entirety. And we want to introduce a type of predator, and that predator is a market maker and a HFT operator. So the avenues we've got is whether we represent that logic in a HFT level, right, agent, or we deploy an algo. And also, imagine we are. I'd like to use the AI example from TWAP. We've got an alpha-seeking TWAP algo. We've got a market maker and we've got a market taker that actually tries to front run a trading algorithms. And in that case, the alpha-seeking TWAP wouldn't know about the existence of another algorithm, because guess what? We're running them in different ecosystems, perhaps different instances of the algo engine, so they can't introspect anything. Number one. Number two, given that all of the markets we play in nowadays are anonymous, they just don't know what it is, right? Whether it's an agent, whether it's an HFT agent again, right, or another algo. I don't know if it answers the question, but that's the approach. Right? Basically, isolate it and take advantage of the anonymous trading aspect of the exchange.
All right. Yeah, that was a good one as well. And I think we are now exceeding the time limitation that we had. But still, if there is anything that you want to share, Vlad, before we wrap it up, just go ahead. And in the meantime, let's give it a minute or two for the audience to just leave their last comments and questions, if there will be any, so that we couldn't miss them. And anyway, those who are watching this live, we will be publishing the recording of this session on our YouTube channel, and I will share that recording with Algotech and Vlad as well. Probably they can also cross-post that on their channels, and you will be able you'll be able to find the recording afterwards. And yeah, Vlad, is there anything that you wanted to share as a conclusion of this session? Please go ahead.
Okay, I guess the conclusion is sessions of this nature. So an hour limit is an hour limit. It's always race against time. I strongly encourage everyone to read kind of a philosophical document that we shared, and usually it's just a blog post. It kind of gives an overarching, like, high level idea how we think about evolving autonomous systems, and then ask questions. And I also wanted to highlight, right, rightly or wrongly, I firmly believe that we are on the verge of something fundamental in the AI space, right? And LLMs and all that advancements, right, is certainly very encouraging, but dare I say, we haven't seen anything yet.
Yeah, thank you so much, Vlad. I have just put the link that you shared before here as a subtitle, and you can guys also find that in the video descriptions wherever you are watching this video. And I think this is time to wrap up this session. And Vlad, thank you so much for such an insightful conversation. And that was definitely one of the most interesting topics we touched, considering that our audience is mostly blockchain professionals audience. And anyway, that was still very interesting and one of the most interesting sessions that we had here in our community. And thank you again. And Vlad, we will see you next time on our stage. Anyway, you are available. And if there will be any more questions coming after the recording is published, I will let you know, and hope to see you again here on our stage.
Alec, thank you so much. It's been a pleasure. I really enjoyed the quality of questions, and big thanks to the audience for very interesting questions. Always learn from them, and hopefully I answered some of them.
Yeah, people are saying thank you words. And yeah, thank you to our audience for coming and joining. Thank you everyone who watched this as a recording, and bye bye. See you soon.
Thank you for the pleasure, Viktor.